For ON24, this is Mitchell Whiteman. We're at the headquarters of Merrill Lynch in New York. And now we're speaking with Henry Blodget, the head of Internet Research. Henry, thanks for joining us today.
Thanks for having me.
Henry, regarding the pricing structure of both business-to-consumer and business-to-business companies, with technology that can search the web to find the best price anywhere, will margins eventually be going to zero, if not a fixed regulated margin?
I think you'll continue to see pricing pressure, clearly. And in the current environment in business to consumer, where there are 10 companies going after every opportunity and they all have capital so they can afford to lose money right now, you're going to have a very competitive pricing environment. Over time, though, the best companies, the most efficient companies with the largest volume should have the best prices. People actually shouldn't need to search, and a lot of them won't, frankly. So we think ultimately Amazon and companies like that will have a piece of the market where they have very good low prices. They might not be the lowest prices at that instant, but they will be good low prices, and they will continue to keep their user base the same way that Walmart has. Walmart doesn't have the lowest prices on everything that it sells at every time. But again, it continues to hold its customer base, and we think the same thing in B2B as well.
Will there be a service component that enters in as the value-added factor to be able to charge a little bit more to get the service at the end?
I think there are a lot of things that go into business-to-consumer commerce on the e-tailing side. People actually will say that price is not the most important factor in their choice of who they do business with. With Amazon, for example, it's often just brand. It is the confidence that the products will arrive on time. It's the reputation. It's the knowledge that you can return the product if you're not happy, and they will go out of their way to take care of you. So price is one part of the component. So in answer to your question, yes, we think there will always be many other components in the top tier of retailers that are going after a consumer base that just wants a little bit more service.
Several weeks ago, you wrote an influential report regarding the AOL-Time Warner merger, and it somewhat moved markets. Why do you think that the AOL-Time Warner merger is such a compelling marriage?
Well, we think that at this point in time, in terms of the collision between the media and communications and internet industries, it is actually beneficial to own both the content and the physical world distribution. And what AOL-Time Warner has now that no other company in the world economy has is both an incredibly strong internet asset, which is AOL, it's the #1 internet asset on the planet, and incredibly strong traditional media assets. And as we're trying to build out interactive television and music downloading, interactive and other just new opportunities that the internet is bringing around, it's very helpful to own both sides because you can hasten the adoption. You can force interactive television. You can create standards for music downloading. Long term, you may see AOL-Time Warner actually divest some of the businesses it currently has. But at this point in time, it owns both sides of the content and distribution, and that will be very helpful competitively, we think.
I've heard Tim Kugel of Yahoo say that his company is the only new media company or even old media company with truly global distribution. Do you see Kugel and Yahoo leveraging that truly global distribution by acquiring an old media company?
Well, we would agree with TK. We think that actually one of the reasons that the internet stocks are worth more than they would objectively look like they're worth is that, in fact, this is a global medium on day one. When you put your website up, you were effectively opening your doors to the entire planet. We've never had businesses that have done that before, so it makes a big difference in terms of the value. You're going after a much bigger opportunity. As for whether we think Yahoo will actually buy a traditional media company, Yahoo's strategy has always been very much a third-party aggregation strategy, so they have partnered for all the content that they need on the site. We think that will continue. We wouldn't be surprised to see an investment from News Corp or an exchange of equity. Having a close partner, especially with such a global player like News Corp, would make sense, but we don't think that Yahoo will suddenly rush out and buy Disney or News Corp or another traditional media company.
Will the dynamic be so that there can be several strategic investments from large old media companies into an internet play?
That's certainly possible. That makes a lot of sense for a lot of reasons. Again, if Yahoo's value proposition to its users is as a third-party aggregator of multiple forms of content, certainly it would seem on the equity side as well. Yahoo has always had a traditional media partner. SoftBank is a very strong company and obviously has a lot of media assets, so they do have a very big partner.
With the dizzying valuations of internet stocks now, and individual investors get to play venture capitalist a little bit because the companies are going out to the public so early, this calls for alarm and kind of moving that forward. Is there going to be a time that you think when individuals will be able to invest in venture capital funds to kind of bypass the dizzying valuations of early public investing?
We think the Internet, as it is doing in the rest of the economy, will ultimately democratize finance as well. It will open up more opportunities to more people. Now, that said, the problem with venture capital in terms of individuals investing has never been a lack of desire of individuals to put money into venture capital investments or the physical ability to do so. The problem really is the number of qualified opportunities. And there are many, many institutions with an extraordinary amount of money that will always be first in line to invest in the best venture capital companies, just because an institution has so much more influence because it's got so much more capital. So even though the Internet should reduce a lot of the friction and should reduce friction in the private markets, it's not going to take care of the problem that in a market like this, where private investing is incredibly profitable, you just have much too much money chasing too few deals.
You talk to venture capitalists all the time. You read a ton of business plans. You see all the new ideas that are out there. You know, to borrow the phrase, the new thing, what's going to be hot? Is it wireless or B2B? What is the most exciting aspect of this new economy moving forward for you?
Well, I think given the magnitude of the opportunity and the activity, we probably see 1/20% of all the new things that are coming along. But three big trends right now are clearly international. The U.S. and business to consumer is actually starting to slow down. It's becoming a more mature market. International markets are growing twice as fast as the U.S. So we look for companies that have strong international operations, or you look for companies in international markets. Second, clearly, is wireless. Wireless is a big opportunity. Lots of companies are going after it. It may change the competitive landscape of the existing providers somewhat. So again, there are a lot of ways to make money in that sector right now. And interactive television is another one that's not particular. Certainly in AOL will be there. You can invest in interactive television technologies. So just other platforms in general would be the third.
And as a final question, in the sector that you cover, who are your top three picks?
Well, we cover three sectors right now at Merrill Lynch. We cover business to consumer, which is the AOL, Amazon, Yahoo group. We cover infrastructure, Inktomi, InfoSpace, and Real Networks, and we cover B2B. And in each sector, we do have some leading companies that we think are favorites. And across the whole sector, we probably have 10 to 15 what we would call core holdings that would form the basis of any Internet portfolio. Just running across some of those in B2C, AOL, Yahoo, Amazon, and eBay would be good companies. DoubleClick as well. In infrastructure, Inktomi, InfoSpace, Real Networks, there are three core holdings, and then in B2B, Internet Capital Group, Ariba, and VerticalNet.
Do you have a pick to win the NCAA basketball tournament?
I don't. You can ask Ed that. One of my colleagues is a big basketball fan, but I don't know anything about it.
I'd like to thank Henry Blodget, the head of Internet Research at Merrill Lynch, for joining us today. It's been a pleasure hearing about his sector and his thoughts on the future. Thanks, Henry.
Thank you very much.
For ON24, this is Mitchell Whiteman.